Good afternoon, everyone. Welcome to the Edgemoor Investment Advisors third quarter 2019 market review and outlook. I'm Jordan Smythe. I'm here today with my colleague Gay Truscott, and we appreciate having so many of you join us for the next half hour, particularly those who were up late last night watching the Nationals win Game 2 of the World Series. Go Nats! For those of you who aren't Nationals fans, we'll try to keep the celebration during this webinar to a minimum. We framed our presentation today around several of the key questions that we're hearing from clients. Gay will start by reviewing current economic conditions to answer this first question: what is the likelihood of a recession? I'll then tell you whether we think the impeachment proceedings might impact the market, and also discuss some of the other risks that we see to the market and the global economy. Gay will share our thoughts on the stock market's current valuation, and I'll conclude our prepared remarks with a summary of our outlook for the coming months and a few specific examples of the opportunities that we're finding today. We'll spend about 10 minutes at the end of our session answering your questions. Thanks to those of you who've already submitted questions when you registered. Anyone else who would like to ask a question during the session can do so by clicking on the Q&A link, which you should be able to see at the bottom of your screen. You may need to drag your mouse down so the cursor just hovers over the bottom portion of the screen, and you'll see a little Q&A button there that you can click on to submit your question at any time, and we will answer as many as we can at the end. The first 3 quarters of 2019 have been great for stocks. In fact, the almost 21% return of the S&P 500 index through the end of September was the best first 3 quarters since 1997, and the market has since added slightly to those gains as we enter the fourth quarter. The S&P 500 is now trading for less than 1% below its all-time high that it reached in July. Overall, we expect the good news to continue to outweigh the bad, but we wouldn't be surprised to see stocks take a bit of a breather or at some point even pull back. We look forward to sharing some more details with you, and I'll now hand the presentation over to Gay, who will get us started with a discussion of current economic conditions.
Thank you, Jordan. So a frequent question we get from clients is about a recession and whether we see a likelihood of one on the horizon. So to answer it, we'd like to look at several economic factors listed here, including employment and wage growth, consumer spending, interest rates, GDP growth, and the yield curve. So let's start with employment. Not only is employment strong, but unemployment is now at a 50-year low. As shown on this slide, the rate has been steadily declining since a recent high of 10% in 2009 and measured just 3.5% in September of 2019. Wages are growing, and the growth rate has been trending kind of in a range of 2.5% to 3% for some time, but with a small blip in the most recent quarter, which we think is just an aberration. This is actually a slower growth rate than has been typical in prior economic recoveries, which has been puzzling, actually, to many economists given the tight labor market. Some possible explanations include higher worker productivity due to technological innovation, as well as low inflation, which has really meant less pressure on employers to pay higher wages. Consumer spending is really important because it accounts for about 70% of U.S. GDP. You can see that it has been rising steadily for the past 10 years, thanks to the strengthening job market, as well as a strong housing market, and as I mentioned, low inflation. So the U.S. consumer really does remain one of the major and most vital drivers of economic growth in the U.S. Interest rates are another key economic indicator, and they remain at historically low levels, as seen in this slide that shows the 10-year Treasury rate going back to 1965. Low interest rates really have been a boon for our economy, as they make everything from home mortgages to car loans cheaper for us all. And our expectation is that low rates will continue. as Fed policy really has remained accommodating. We can see on this slide that the Fed funds rate, the Fed began to increase rates fairly steadily through 2016, 17, and into 18. But based on some recent economic signs of slowdown, the Fed reversed that policy in July and September and reduced the Fed funds rate twice. So we really do expect that to continue in the near term. Focusing on just the U.S., GDP growth has been pretty healthy for the last several years, averaging in sort of the 2 to 3% range. Recently, you will see on this slide, GDP growth has slowed from 3.1% in the first quarter of this year to 2% in the second quarter and to an estimated 1.8% for the third quarter of 2019. And this slowdown is due in large part to the uncertainty created by the trade and tariff wars, which have really dampened economic growth. So our expectation is that U.S. GDP growth will average kind of in the 2% range in the coming quarters, which, while slow, is still positive and encouraging. So finally, if we're talking about recession risk, we have to talk about the yield curve. The yield curve measures the difference between long-term rates, represented here by the 10-year Treasury, and short-term rates, shown here by the 2-year T-bill. There's typically a positive spread between these two rates, but when this difference turns negative, i.e. when long-term rates become lower than short-term rates, it's called an inversion, and this can be an indicator of a recession to come. We did see a brief yield curve inversion last summer that spooked some investors. But before we draw any conclusions from that, I want to remind everyone of some important facts. Really 3 facts. First, historically, in cases where a yield curve inversion has predicted a recession, there has been a considerable lag time between the two, averaging 12 to 18 months. Also, inversions themselves typically need to last for up to 6 months to be reliable indicators. So that brief inversion I just mentioned that occurred in the May-June timeframe reversed itself by September. So it really did not meet this threshold of duration. And finally, many argue that we are in very different economic times, with the Fed continuing to take measures to ease monetary policy to ward off economic recession. And as we've stated, we really don't see that policy stance changing anytime soon. So our belief is that there is not a high likelihood of a recession in the near term. Just to quantify that, the New York Fed actually puts a probability of recession in the next 12 months at just 30%. We also should note, however, that even if we do have a recession, that won't necessarily lead to a bear market. And conversely, we could have a bear market without a recession. So with that, I will hand it back over to Jordan to discuss a few more questions we've been hearing from clients.
Thanks, Kay. The impeachment proceedings in the House of Representatives are grabbing lots of headlines and raising questions about the potential impact on the stock market. Clearly, these proceedings add yet another element of uncertainty that causes concern among investors. And of course, we can't predict the outcome of the process or the exact impact that it will have on investments, but we can look back at what happened in the stock market during previous proceedings. During the months leading up to Nixon's resignation in 1974, stocks continued a decline that started at the beginning of 1973. It had been going on for a long time and really reflected the current economic conditions, much more so than anything related to the impeachment. Similarly, but moving in the opposite direction, stocks rose during the Clinton impeachment hearings in 1998 and 1999, which was also a continuation of the long upward trend that we saw in the stock market during the 1990s. Our conclusion from looking at these previous episodes is that investors were more focused then on economic conditions and other market fundamentals, and we expect similar behavior during the current process. We think that the issues that we're talking about today, for example, both the positives and also the potential risks are more important to what's going to happen in the market over the coming months, even despite the distraction of the impeachment process. As for some of these other risks, the trade war we're having with China and other nations is, in our opinion, the biggest threat to the global economy and the markets. We're already seeing a sharp slowdown in global trade as a result of tariffs and other actions, as you can see at the right end of this chart of global trade growth rates since 2000. Global supply chains are shifting as companies try to find sources outside of China, moving to Vietnam, Thailand, other sources. And the uncertainty around the trade issues makes planning for long-term investment difficult for businesses. In contrast with the earlier chart showing the steady rise in consumer spending, this chart shows the tapering of business investment in recent months, which is primarily due to trade uncertainty. We do remain hopeful that there will be some progress on the trade front. We believe the administration will want to do what it can to boost the U.S. economy heading into the 2020 election, even including possibly accepting only incremental reform and claiming victory. As Gay said, we don't expect a recession in the near term, and progress on the trade front would likely enable the U.S. economy to continue to expand at a modest pace. However, failure to resolve trade issues could lead us into a recession. Slowing economic growth and other impacts of trade wars are reflected in corporate earnings this year. Corporate earnings, as we often have discussed, are the foundation for the market, and stocks are unlikely to continue their strong run without support from ongoing earnings growth. This chart shows the earnings per share for the S&P 500 index. The numbers through 2018 are actual historical results, and the gray columns for 2019 and 2020 represent estimates for the current year and next year. Earnings have risen dramatically since the financial crisis. However, and you can see the big bump in earnings that we got in 2018, partly due to the corporate tax cuts that went into effect that year, but also partly due to just strong underlying business fundamentals. However, earnings growth has stagnated in 2019. Earnings are actually down so far this year. We have actual results through 2 quarters, and the third quarter may be another quarter of a decline in earnings compared to the same period last year. But we expect earnings to pick up in the current fourth quarter and be close to 2% for the full year. Companies with global revenues are faring worse as a result of the ongoing trade war. We're seeing that in the earnings as they're reported. Estimates for 2020 call for resumption of growth at higher rates. Now, these estimates may fall during the year, as is typically the case, but we are optimistic that earnings results will be good over the coming quarters. Gay will now share with you our views on current market valuations.
Thank you, Jordan. So, is the stock market currently overvalued? Another question, common question among investors, and really not a surprising one, given the 10-plus year run of the current bull market. So let's look at several valuation measures to try to answer this question. This slide shows the forward price-to-earnings ratio for the market as measured by the S&P 500 index over the last 25 years. The dashed line in the middle shows the 25-year average as 6.2 times forward earnings. That compares with a current PE ratio as seen on the right-hand side of the slide of 16.8 times at September 30th. It's advanced, continued to advance since then. So roughly a current PE ratio for the overall market of about 17 times. There are other valuation metrics like price to book value and price to cash flow that we look at. But really just focusing on this forward PE ratio indicates to us that really the market is fairly valued at this time. However, we should point out that these historically low interest rates that we expect to continue really justify higher than average equity values, which suggests that the market is modestly undervalued. All in all, we do believe that equities remain attractive and important parts of long-term investor portfolios, and are certainly more attractive than long-term bonds. But as always, selectivity and discipline are really key factors for investors to keep in mind. So I'll turn it back to Jordan to conclude with our outlook and a view of some of our specific opportunities we see today.
Before I conclude with this summary, let me just remind you, please, if you have any questions you'd like to ask, just click on the Q&A icon down at the bottom of your screen, and we'll answer those in a few minutes. I'll now give you a summary of our outlook for the coming quarters and a brief discussion of several of the stocks that we're currently buying. As Gay and I have both said, we do not expect a recession in the near term, particularly if we see progress in resolving trade disputes. Also, remember that even when we do have a recession someday, a bear market will not necessarily follow. We expect a resumption of earnings growth as the Fed supports the economy with additional rates cuts, and the U.S. economy will likely continue to expand more rapidly than others around the world. These first few points are largely dependent upon resolution of at least some of the trade issues, and as I mentioned, we continue to expect there to be some resolution and progress there. The combination of ongoing economic and earnings growth should allow stocks to hold and even add to their gains, and we will be keeping an eye on the meantime on the risks that we've outlined here and any others that may arise. In this current market environment, we are finding stocks that are trading for less than what we believe they're worth, and we continue to include both foreign and domestic securities to adequately diversify our portfolios. On the next page are several examples of the securities we are currently buying. These 5 include Applied Materials, which is a technology company manufacturing semiconductor manufacturing equipment. CVS Health operates the retail stores that you know and see everywhere, and also through its relatively recent acquisition of Aetna is one of the largest health insurance companies in the country. Enbridge is a pipeline operator. It has pipelines across North America transporting natural gas and crude oil. Microsoft, you know, as the largest software company, and in fact, not one of our very largest holding now. It's always been a large position for us and has done very well, so it is now our single largest holding. And finally, United Rentals is a North American equipment rental company. Looking at the first column, forward price to earnings, think back to what Gay discussed in looking at valuation in the current market and the overall market PE being about 17 times. 3 of these, Applied Materials, CVS, and United Rentals, trade at a discount, which is a reflection of our efforts to find companies that we think are undervalued and have more appreciation potential than the broad market. Microsoft has the highest PE here at 26 times. But when we look at Microsoft, what we see is a company that we think is much better than average. And the combination of growth potential, which you can see if you jump over to the third column, at growth of almost 12% a year projected for the next 5 years, and the strength of its brands, its competitive positions, its management, we think that premium is justified. And then moving back up a line to Enbridge, the pipeline company, it trades right around a market multiple, but looking at the dividend in the next column of 6%, that's a very high dividend yield. And in fact, Enbridge is an example of one of our income investment holdings. We hold it primarily for that current yield of 6% now, but also for long-term appreciation potential. The others, staying in this dividend yield column, the other 3 of the other 4 all pay nice dividends. United Rentals is the exception. Most of the companies that we own do have very attractive dividend yields. United Rentals does not pay a dividend. However, the combination of its low multiple of earnings, the PE multiple of 6.4, combined with, in the third column, the 12% higher than average projected growth rate, make us think that it's a very attractive long-term investment, even without a dividend yield. And finally, I'll just, in the third column, highlight that all 5 of these companies have are forecasted to have nice growth in earnings over the coming years, something else that we look for in our investments. These are 5 of the of what we're currently buying for our portfolios, and we are always on the lookout for others that we can add that would complement what we currently own. We've now concluded our prepared presentation, and we'll turn to your questions. Feel free to submit any questions you might have by clicking on that Q&A link at the bottom. And let's start here. We have one. Gay, I'll hand this one to you. Are you concerned about the U.S. deficit and debt?
We are. We do think federal deficits are an important, what I would call structural issue in the economy, and that over the long term can dampen economic growth and potentially lead to recession. There are a lot of measures of federal debt and deficits, and one that we focus probably the most on is a debt to GDP ratio, which has been steadily rising over many years. So yes, it is something that we watch closly, and as I said, are concerned about kind of as a long-term structural issue. But I would say that in the near term, as a near-term indicator of recession, we didn't include it in kind of the list, but I would say that it's not something that we are concerned about kind of in the near term.
Okay, we have another question here asking about Brexit. What are your thoughts on Brexit and the impact on the markets? We'll admit to having a hard time keeping up with the twists and turns and the ongoing Brexit discussions and negotiations. And we will hold out hope for a resolution there that will not be more disruptive than it has to be. That it's currently being to the markets in the global economy. We don't know what to expect. We do think that, I mean, behind our optimism that something will get worked out is that we do believe that it is in everyone's best interest for the United Kingdom to continue to have good trading relationships with Europe and the United States and the rest of the world, and that one way or another those issues will get straightened out. But that is, look, that's one of several points of uncertainty that we could point to right now that we're just keeping an eye on and following as best we can, and just we'll hope that they can get some resolution there and provide some more clarity. Okay, Gay, I'm going to, let's see, I'm going to ask you this question. What changes to the portfolio might you make if you do see recession looming on the horizon? And I would just add, see as best we can. We, of course, can't predict accurately exactly what's going to happen there.
You can't? I thought that was your job. He's got a crystal ball in his office, so I figured that's what he was doing, but I guess not. No, in all seriousness, yes, there are changes, adjustments to portfolios that we make all the time. But I think it's important to start by reminding everyone, that we are not market timers, meaning that, we do not make major moves in and out of the market. That kind of a strategy has proven over the long term not to be successful, and it's certainly not tax efficient for investors. Instead, we really do believe in staying invested in quality companies through market cycles. We also believe in maintaining a diversified portfolio with a proper asset allocation to reflect each individual investor's need for income, time horizon, and kind of overall risk tolerance. So, but having said all that, as I started out by saying, we do make, and we have made sort of adjustments, I would say, to portfolios. For instance, we have been buying some short-term bond funds in the income portion of balanced portfolios for the last several quarters. And this is really to provide, what we call ballast or sort of stability against volatility on the equity side of balanced portfolios. So we do see that kind of balance as being important. And in addition, as always, I guess, the dividend income that we generate in the income, primarily in the income portions of balanced portfolios, provide a very important cushion against a downturn in equities as well. So all of these factors really play into our strategy to create the most durable, kind of conservative and defensive portfolios that we can for our clients.
We have one final question here that relates to the question you just answered, Gay, a bit, which is, what are your thoughts regarding gold as an investment? And I think we had a similar question previously. We've never been big fans of gold as an investment. It doesn't have any intrinsic value, unlike many other raw materials. It has very few industrial uses, for example, and really is valuable because people think it's valuable and say it's valuable. And that's not the type of opportunity that we look for. We think there are better ways to protect a portfolio from downturns in the market, or help a portfolio weather those downturns, as Gay mentioned. And part of the reason why we think others are better is that gold has had very poor performance over the long term. Yes, it's done well for short periods of time here and there, but really has not been a good long-term performer. So we look elsewhere for good investments for our portfolios. We're approaching 4:30 and the end of our scheduled half hour with you today, and I want to make sure we conclude on time. If we did not get to your question, we will follow up with you to answer it. Thank you again for attending. We hope you enjoyed this presentation and the webinar format, and we welcome any comments or suggestions you might have for future events. We also, speaking of future events, hope to see you at our upcoming annual reception at Columbia Country Club at 6:30 on Thursday, November 24th. We'll be back here in 3 months Thursday, November 21st. Thank you. We'll be back here in 3 months for another quarterly update. Have a good evening. Go Nats.